Well, the project is a very conventional gold project, open pit, cyanidation process. There are hundreds of them around the world. It got into a bit of bother as a project in Ethiopia under the previous owner, who had assumed a much higher gold price in the way they designed the project. And that means that a whole bunch of costs and other design parameters were built in that were inappropriate. And what KEFI did was to buy the project about 2 years ago and to redesign the planning parameters so that it works at a much lower gold price. It's a very robust project. It can do quite well at prices well below where they are today. And the Ethiopian government is very keen for us to get on with it. The main point is that we've expanded the resource base quite dramatically by putting in a lot more information, which means that we can have more selectively designed the mining technique. So we've dramatically reduced unit production costs, dramatically increased the profit margin. So the investment proposition has changed mainly by reducing the capital requirement, reducing the risk involved by lowering unit costs, and increasing the returns quite dramatically. So all the investment parameters and measurements like internal rate of return or net present value or average profit, all those types of measures have gone up through the roof compared to what they were before. So it's essentially a very conventional gold mine proposition in a very development-friendly jurisdiction, being put onto a footing by very experienced consultants, management and contractors, so that it makes good money at today's gold price. Well, there's really two things principally that I would say about the equity dilution topic per se. What most companies do in the junior space is to sort of batten down the hatches and in a sense go into hibernation, often referred to as zombie companies. What KEFI has done is to keep its eyes out for opportunities to buy projects which add enormous value to shareholders' returns by buying them extremely cheaply and then getting them into production as cost effectively as possible. So buying resources at $5 an ounce and then turning it into a viable development proposition at current gold prices will add so much value, if you like, to shareholders, that the cost of the finance, be it equity finance or debt finance, is more than carried by the returns that are generated by the exercise. So what I'm saying is, sure, there is equity dilution in such an exercise because one has to fund early stage capital investment with equity capital. But if it's value accretive, it's value accretive, and that's really quite the end of the story. There's nothing exotic about the mining method. It's open pit mining, and all we're doing is we've costed into the process, or the planned mining process, some extra machinery and extra labour to do a bit of selective scraping when I was taking away a bit more of the waste, so we don't take waste to the process plant. And by building in that extra cost, it actually removes some of the waste from the material that otherwise would have had to have been processed. And that means that we've maximised the head grade or the quality of the ore that's delivered to the plant for processing. So there's no magic in that. It's just a matter of, instead of just simply doing what you'd call bulk mining of taking everything to the process plant, what we've done is to remove waste and take the rest to the process plant. And we've put in some conservatism factors, for safety's sake. Well, the Arabian-Nubian Shield, to an Australian geologist, or for that matter, a Canadian geologist, it comes from a suite of geology, a rock type that is directly comparable with that of the gold yielding districts of Canada and Australia. The only difference is that the Arabian-Nubian Shield, for geopolitical reasons, hasn't been exploited by modern man. It was explored and exploited by ancient man, but because of the politics of the region, hasn't had its sort of modern phase of exploration and development. So when an Australian looks at the Arabian-Nubian Shield, what one sees is that in some decades from now there will be scores of mines there, just as there are in Australia or Canada. And therefore to actually go into the Arabian-Nubian Shield as one of the first people in means that you're pegging and then exploring and then developing ground which is highly prospective, and it's only a matter of time before they are major gold producing districts. Well, to me, Ethiopia is development friendly. A breath of fresh air in the directness and pragmatism of the jurisdiction and the regulators and the government. It's new to the mining game, but the receptiveness we've experienced is second to none. So to me, it's been a terrific experience, and we couldn't have asked for more support than we've received.
Well, Ethiopia has been a very attractive destination for investment generally for the last 20 years. It's had stability and a government that has promoted development to the extent that we've seen economic growth of between 7, 8, up to 10%. So the economy essentially doubling in size every 7 or 8 years. Mining as an investment is relatively new. It's about 4 or 5 years ago that the government of Ethiopia decided to give it priority status. And this project, the Tulu Kapi project being developed by KEFI Minerals, is the one that is, we believe, going to be at the front of investment in the mining sector in Ethiopia. We've therefore had a very constructive responses from the government of Ethiopia to our various requests for help in terms of assisting the project, and we believe that we can create a model with the government for future mining development, and that others will be able to build on that model.